Good morning and welcome to your Financial Empower Hour. This is Jason Cryderman with Great Lakes Investment Advisors. It's been a while, Tony, since you and I have recorded a live show. We had to take a couple weeks off there. So I know all my viewers and my listeners, you're thinking, wait a minute, I know I listened to you last week and the week before that. And you did, because of my awesome radio team that Mr. Tony Shore runs, is in charge of out of Minneapolis, Minnesota. They do a phenomenal job. And so thank you, Tony. Whenever we can't record a show, Tony and I always record these shows on Monday, and then they air the following Sunday. Whenever we can't record a show, Tony and you and your team, you do a phenomenal job finding one of our previous shows and throwing it out there and getting it on the radio. And that's awesome, because I'd really hate for on a Sunday morning for my listeners to tune in and all of a sudden they just hear like dark air, like nothing there, nothing there but static.
Yeah.
So that wouldn't be good.
Dead air, or maybe they didn't get a show, so they're just playing polka music. You don't want to hear that.
No, we don't really want to hear that. No, not in place
An hour of polka music.
Not that there's anything wrong with polka music. For those of you that love the polka music, we just don't want you expecting to listen to our show and then have to go through an hour of polka. So, but anyhow, so it's been a while, Tony. It's been 2 or 3 weeks since we've been able to record. I've had just so much going on with my family, and most of it all really good, wonderful stuff. But what's been going on with you, Tony? How's life been the last couple of weeks?
Well, it has been great. And, we had a holiday in there, and my family and I, all my kids, their significant others, my wife's brother and his family, and my mother-in-law, 14 of us went out for Sunday brunch 2 weeks ago.
So that was for Easter Sunday?
It was a special Easter Sunday brunch.
Wow.
And it was at a nice place. It was pretty pricey. Don't normally spend this kind of money eating out. And I knew that we'd probably end up picking up the tab or splitting it with my my mother-in-law. So what I did is I ended up, Jason, to make sure I didn't lose money on the deal, I ended up eating my own weight in Eggs Benedict.
Well, last I think we talked within the last 6 months or so, you went to an occasion where you ate your own weight in pizza. And you went to you and your wife and your family went to an event. I can't remember where it was. You were telling me about this.
Yeah.
Anyhow, so
I don't remember either.
You're upholding your end of the bargain.
Yeah.
Like you say, you got to get your money's worth, right? And you're paying for that many people. You got to get your money's worth for yourself. So,
but it was the best Easter brunch I've ever went out to. They had smoked salmon, they had cheesy hash brown dish, they had eggs, but the Eggs Benedict was fantastic. In all honesty, I had at least 3 Eggs Benedict, maybe 4. They had a good French toast bake. It was mimosas. They had the whole spread.
They had the whole 9 yards. Yeah.
Yeah. But we all enjoyed it. It was great to have the kids and their significant others. How about you? What did you do? I haven't even talked to you.
No, it's been a while. So let's see. Well, we had spring break. So I know 1 week, my family and I, we were off to spring break. So that was a wonderful, wonderful time. And then of course we did have Easter that fell in there. And I believe it was the day after Easter, my wife actually had a surgical procedure done, so we were out of town for the day. So yeah, we've been busy, and the kids have all been super busy. Carson's in full swing, no pun intended, but he's in full swing of baseball. He's playing travel baseball for the Michigan Batman Association. He plays 11U travel ball, and then he also plays Little League for Sanford. So he's on a Sanford Little League team. They're starting their first round of games this week. So now for about the next month and a half to 2 months, we'll have games every Monday and Wednesday night. We'll be either down at the Sanford Ball Diamonds or one of the local other Little League teams we play, like either in Gladwin or Bullet Creek or Clare or Coleman, those areas. And the girls are really super busy with track. It's track season. Lexi is a senior. Josie's a freshman. They're both on the same track team for the high school. It's really cool. They're both sprinters. And so they both are running relays together. They both run the 4x1 and they both run the 4x2. Josie is the lead leg on both of those relays. And then Lexi's the final leg on both those relays. So it's pretty cool. It's pretty cool to have both girls running on the same track team.
And your kids do so well in sports.
Yeah, they do. They're super athletic. They really are. And they're super, just, they're great kids, right? They're all around great kids. They're awesome in school. They're really athletic. So all of my listeners and viewers, you always hear me talk about the kids, Lexi, Josie, and Carson, and how busy they are. And they are. And so Amy and I just, we divide and conquer, and we chase the kids around. And so it's been awesome. It's been a great spring so far. It's been really busy with the kids. The weather is finally breaking over here, Tony. We're finally seeing some nice 60 plus 70-degree days, sunshine, grass is getting green, trees are starting to bud. It's a beautiful spring in Michigan.
Well, that's great, but I've got some bad news on the weather front for you.
Don't send any of that our way, Tony.
We experienced the same thing. I mean, we had 2 days where we were in the upper 60s. We had a few days of sunshine and 60s. The grass is green.
Yeah.
Beautiful. We're like, oh, winter's finally over.
Finally.
But today, as we speak, I look outside, it is pitch black.
Oh no.
And it's in the middle of, when we're recording this, it's daytime, of course. Yeah. And have severe weather advisories for thunderstorms, tornado, possible tornadoes, torrential rains, and hail. So I hope you don't get any of that. Well, we haven't seen it yet, and you never know. This is what the weather is predicting, but we'll see what actually happens, right?
Well, let's hope. I wish the best for you guys over there.
Yeah.
Hopefully not too much wind damage, hail damage. Yeah. Hopefully none of those darn tornadoes. For all my viewers and listeners that already know, Tony's over in Minneapolis, Minnesota, over to our west couple states. So usually a day or two after whatever Tony gets weather-wise, we get a portion of that. But so I hope not, Tony, for your sake. And I really hope not for our sake over here.
Yeah.
Hopefully it's things, what a profession to have as a weather person, right? I mean, we always joke around. If you could have a job that you could maybe possibly be right half the time, maybe possibly not be right half the time, because it's a 50% chance it might rain today. It's a 50% chance it might be cloudy, and you still keep your job. I mean, what a different career to have. But that's not you, Tony. That's not me. We have to be spot on.
We do. But there is somebody in the financial world who is like that, who might be wrong more than weathermen. And I'm not going to name names, Jim Cramer, but that guy, I don't know if you've seen that guy on CNBC, but I think if you look at his track record, this is why you're constantly telling people, and I've learned from you, Jason, do not try to time the market. That doesn't work.
Well, let's think about, first of all, you mentioned like Jim Cramer, and I've had some guys sitting here in my office say, that guy's crazy. He's nuts. And other people love him. And you will. People love him. People don't. But keep in mind, first of all, we're really going to jump into today's show about, we're going to really talk about a lot of investing basics today. Just break it back down to what is a Roth? What is an IRA?
Yeah.
What are different types of investments based on risk level and return and those types of things? But I'm glad you pointed that out, Tony, because one of the things before we take a break here and jump onto the next segment is I really want our listeners and viewers to understand when you hear something, whether it be from a talking head, somebody you hear on TV or on the radio or on the internet, like a Jim Cramer, like a Dave Ramsey, or an advisor. First of all, think about what is their background. Are they licensed to give recommendations? Are they licensed to give investment advice?
Sure.
If so, what type of licenses do they have? Meaning, what type of advice can they be giving? Or more importantly, are they just generally talking? It's one thing to generally talk, and you don't need licenses to do that.
No.
So to generally talk and give their personal opinion, even though they might have 50 years of knowledge and all this research, that's great. But think about it for a minute first. Is that advice? Are they licensed to give that advice? And most importantly, Tony, is that personalized advice directed directly at you?
Because they don't know your individual situation. And I would say the main reason they don't have a crystal ball. So Jim Cramer might try to tell you where he thinks the market is headed,
absolutely.
And he's making predictions. He's looking at stocks. He's breaking them down. He's making predictions, and he would tell you he's trying to educate as much as anything. But he ends up, probably sounding a little bullish on some stocks and bearish on others. But the reason you have to take that with a grain of sand is because he doesn't have a crystal ball. Neither do
Correct.
you
None
or
of us
I.
do, right?
Yeah.
None of us do. Another thing, and again, I'm definitely not, nor are you, Tony, accusing anybody of anything here. We're just kind of trying to help, again, educate the public and help us open up our eyes to look at it from a different perspective. And remember, a lot of times when we hear things on TV or radio, that there's a lot of behind the scenes thing going on to what type of station or channel are you listening to? What's their main demographics? Who are they kind of talking to as a majority, as well as who pays the advertising on that station or channel and around that show, because certain shows or demographics are really designed for certain listeners. And so, for example, if you're listening to Mike Avery, who is on this channel that we're on, either for me, chances are you're an outdoorsman. You like hunting and fishing because that's what Mike Avery does. So a lot of a lot of the commercials during Mike Avery's segments are revolving around hunting and fishing and boating in the outdoors, which is awesome. Mike
we
Avery
love
and I
that.
get along really good.
Yeah,
we get along. That's one of the reasons I kind of tag along right by him and his shows, because a lot of his listeners and my listeners have a lot in common. So, but that's important to talk about. Just again, remember who's talking. What's their background? Are they licensed? Are they truly giving advice, or are they just making thrown out blanket kind of information or blanket recommendations, if you will? And are they giving personal advice that's designed and catered and custom just for you? That's important to take into consideration.
Yeah, it is. Obviously, individual advice is the best. You can have people who prognosticate on different stocks or try to predict things, but they're just talking in generalities. You need to work with an individual, independent financial advisor who's going to get to know you and your personal goals and your needs and learn where you're at specifically, and then make a decision based on your personal risk tolerance. So before we move on and start talking about the markets and defining investments 101 to give some education, let's let our listeners know how they can get a hold of you to set up that no charge, no obligation consultation to get a plan in place.
Yeah, and that's a great opportunity for those listeners or viewers out there that say, gee, I don't have a plan in place already. Or, hey, you know what? I'm going to do it myself, or I think I'm doing pretty good, but I just want a second opinion. I just like somebody to tell me where I'm doing good, and maybe I help identify some of the areas I might want to look into a little further and do something differently. Or maybe it's someone you have a plan, you're retired, or maybe you have another advisor that's working for you. And again, you just want that second opinion. You just want to identify, what road am I on? Am I on the right road, no matter what phase of investing your life I'm at? Please feel free to give us a call here at the office. That's definitely, Tony, something we do. We do what's called a portfolio stress test and second opinion. And it's no more than exactly that, a second opinion. We'll take a second set of eyes, and we'll just take a look at what you're doing today. Where's your risk exposure? What are your fees you're paying today? Internal fees, external fees, commissions, whatever it might be. What are your interest rate risks that are potentially out there with interest rates and inflation and those things? So we'll just give you a second opinion. What road are you on? And then we can give you some ideas that if you were to do things differently and improve, by all means, you could take that information, go back to your current guys or gals you're working with. You could do it on your own, or that's an opportunity for you to ask us, what would it take for us to build a relationship together? What would it take for us to be one of your trusted fiduciary advisors? So again, there is no cost. There's no obligation for this portfolio stress test. It's a simple second opinion. And Tony, the best way they can get that is just give us a call here at the office. Our phone number is 989-835-7203. Again, that's 989-835-7203.
All right. Thanks, Jason. And listeners and viewers out there, a reminder, you are listening to Great Lakes Investment Advisors, your Financial Empower Hour, and our host, Jason Cryderman. And you got a great team over there at Great Lakes, Jason. And I encourage our listeners to pick up the phone, give your team a call, set up that consultation. And let's continue today's discussion. Now, we're talking about investment basics today, Jason. And I'm glad you can help us out here, because that way we can get all our listeners and viewers on the same page, right?
Yeah, I think it's a great idea. Every once in a while, we do these shows, Tony, where we're just, I'll call it step back, right? Just kind of step back.
Sure.
I've been a trusted fiduciary advisor for almost 22 years now. Worked with all gamut of advisors and families, whether they're 18 years old and just starting out, they're 35 or 40 in the middle of their career, but transition jobs, or they're 60, 70, 80 years old into retirement. It's important to break down the basics of investing so that we get a good, basically, I'll call it a common knowledge of what types of investments are out there. So that's kind of what I want to gear today's show around, Tony, is let's talk first of all about what types of investments are out there when it comes to, let's call it from a tax standpoint. And then we'll talk about different types of investments when we talk about risk and return, as well as maybe duration or time frame. And no matter what phase you are in your investing time frame of life, you need to be aware of what types of options, choices, investments you have out there. And they're not all right for everybody. For example, the investments that my daughter Lexi's making at 17, she'll be 18 in a month. The investments she's making at this phase of her life are not the same investments that somebody 30 or 40 years old should be making, and definitely not the same investments or management that somebody in their 60s or later in life should have. So you should have a custom built plan based on what phase of life you're in, based on your age, based on a lot of different variables, your age, your income needs, your risk tolerance, your time horizon. There's so many different variables that go into play, Tony. And again, that's why when we take basically the basics of what are investments, and then we custom build financial plans, we call it your financial empowerment plan. We custom build those for every investor or every family that we work with based on your goals and objectives. Tony, I can't hear you, bud.
And it's somewhat, sorry about that, it's somewhat based on your own personal risk tolerance as well, correct?
Absolutely. I mean, a lot of investing has to do with your risk tolerance. And so we have what's called a risk tolerance questionnaire, which is very common. A lot of different advisors that you work with will have you fill out. Maybe it's as simple as 6 questions. Maybe it's as elaborate as 6 pages. But really, you answer a lot of questions that talk about how you feel in your heart and in your stomach, really, about making and losing money. And there's sometimes very deep, very in-depth questions that make you think, if the market's down 40%, how much am I willing to lose if it might never come back?
Right.
Or if it takes 5 years to come back or 15 years. So there's some really serious questions, because that's what tells you as an investor and your advisor, what is your risk tolerance? How much stomach do you have for losing money? Because let's be real, Tony, all of my listeners and all my viewers out there, we all understand. Let me tell you, we all understand that investing in the market can be kind of similar to gambling. There are risk levels involved.
Sure.
Now, you can go up to a slot machine and you can gamble a quarter, or you can sit down at the slot machine and do $5 a spin, or you can go to the high stakes and put down $100 or more per hand at cards. So again, we do these things based on our risk tolerance, what we're comfortable with in life. And that's exactly how your investments should be lined up too, Tony, is what is your risk tolerance? How much are you trying to earn, and how much are you okay losing? And nobody wants to lose money, right?
No.
Nobody sets out and says, well, I
No.
want to lose money today. Well, no, we don't do that. But if we invest in the market, it's an inherent side effect. The market, at some point,
goes up and down.
You will lose money, right? Every
Right.
single day. And there's never been, I don't believe, any one day in history where the market went straight down from top to bottom or straight up from bottom to top. Have there been down days or up days? Absolutely there have, but there's ups and downs all along the way. So,
and the reason you invest is because there's more ups than downs, at least over the last 100 years.
Correct.
It's about, I think 73% of the time.
Yep. Yeah. Good statistic. Yep.
Yeah. 70 plus years, 70% of the years in the last 100 years have been up years in the market.
Yep,
and only about 30 are down 30%. And so over time you can make money in the market, but you have to be properly allocated. And that's what you're talking about. When we say allocation, that means, is all your money in the market, or is some of it, and is it balanced within the market? And then some of it, and say, the safer options where your principal's protected, right?
Yeah, that's right. So that's an important part. So we talked about risk tolerance a little bit. And then Tony, you mentioned allocation. So what allocation means is how much of your money do you have allocated to what I call riskier investments, like stocks, mutual funds, those types of things. And then how much do you have to safer investments, like maybe
Right.
bonds or CDs or fixed investment vehicles, like maybe a fixed annuity or a fixed indexed annuity. So allocation, let's say for example, my daughter, Lexi, she's going to be 18 years old. She's about a 90-10. What that means, 90% equities or stocks or riskier money, more growth opportunity, right? She's younger, she has longer time frame, and then she has about 10% in what I'll call fixed income investments, where it's more like the bonds, a little what we call safer money. Now, my dad, who is, let's see, I'm going to age myself here, but if we look at my dad's age and he's into retirement now, at 80 years old, dad has his portfolio more like a 40%, 35 or 40% riskier money, and the other 60 some 70% in safer money because he's at a different phase of his life. So that's when we talk about allocation, is based on your risk tolerance, based on your time horizon. How much money do you have allocated to riskier investments, and how much money do you have allocated to safer investments?
Yeah, exactly. And so, again, let's take another quick break before we go on. And for our listeners out there who want to have these reports run to see where they're at, where is your 401k at? Where are you at currently? And what kind of balance are you going to need? You need a plan in place. You need to work with a trusted financial professional like yourself, Jason. And I know that you provide a no charge, no obligation consultation to get them a written plan. How can our listeners do that?
So really the easiest way is to call the office here, Tony, 989-835-7203. Can always go on our website at any time. That's greatlakes.investmentadvisors.com. There's a lot of great information on that website. You can request a phone call. You request an office visit. You can just request some of our material or information you may have heard about on the show. You can attend any of our educational workshops. We put on classes anywhere from 12 to 20 sometimes per year that there's no charge. They're complimentary. They're open to the public. But any of those ways, Tony, those are really probably the three most common ways that you can get a hold of us if you'd like a second opinion.
All right. Well, thank you, Jason. And listeners, stay tuned. We're going to be right back with more of your Financial Empower Hour. And welcome back to your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with our host. The man with the plan is, of course, Jason Cryderman from Great Lakes Investment Advisors. And I want to let our listeners know, thanks for tuning in. Thanks for listening today. Your hard work and listening and paying attention will pay off. We're going to give away a few copies of Jason's book coming up, so stay tuned for that. But first, let's keep this discussion going. We're talking about investment basics, and you've already talked about having a diversified portfolio, looking at asset allocation, things like that. It's really important having a plan in place. Looking at your own personal risk tolerance, taking that. What else do we want to touch on when it comes to investment basics for our listeners?
Yeah, I think the risk tolerance was the big one. I'm glad you mentioned that, Tony. And you should review your risk tolerance as well, because again, what my risk tolerance was 5 or 10 years ago is not the same today. I'm sure, Tony, you would agree. Most of
it can change.
It can change overnight, right?
Change for me. Yeah.
Depending on your employment status, depending on your income status, depending on your tax status, depending on risk and growth. And there's so many things, the interest rate environment, the stock market. There's so many things that could change your risk tolerance that it's a good idea. Every maybe 2 to 3 years, reassess your risk tolerance. That's not something you want to micromanage and do weekly, but every couple, 2, 3 years, you should probably reassess your risk tolerance as well as reassess your allocation.
Yeah.
Again, your allocation should be coming directly off of your risk tolerance. How much money can you afford to? Are you comfortable having in riskier investments? And how much money do you want to have in safer, maybe more principal protected investments? So that's your allocation. And then inside your allocation, you're going to have something we call diversification. Diversification is not all your eggs in one basket. We talked earlier in the show that, Tony, we both celebrated Easter with our families over the last few weeks, and we talk a lot about baskets and eggs, right? And so not having all your eggs in one basket is very, very important when we talk about investing. We want to be diversified. You want to be diversified across different asset classes. You want to be diversified across different sectors of the market. For example, and I'll keep this again very high level right now, there are really 9 sectors when we talk about equities and stocks in the riskier side of the market. Tony, there's really 9 sectors. There's large cap companies, there's medium-sized companies, and there's small companies. Those are by market size, market capture of the stock market. And then across those 3 sectors of large, medium, and small, there's growth companies, there's value companies, and then there's the core or blend right in the middle, which is a little bit growth and a little bit value. So of those large, medium, small size companies, growth, value, and blend, that's 9 different sectors in the market. Wow. So you should be diversified at some form based on your goals and objectives. You should be diversified across some or all of those 9 sectors. What I mean by that is we shouldn't have 100% of our money right now invested in NVIDIA or invested in Facebook or invested in Apple. As good of companies as those are, as great as they've grown over the last few years here, you shouldn't have all your eggs in one basket. Right. Should you have some exposure? Sure. The younger you are, or the more risk averse you are, maybe the more exposure you could afford to have. But those companies that I just mentioned, those are pretty much all in the large growth sector of those 9 sectors of the market. We should have some allocation there, but again, based on your personal goals and objectives, you should have not only appropriate allocation of your money based on your risk tolerance, but then you need to assess what is your diversification of the money you have allocated to the riskier investments, as well as what is your diversification of the money you have allocated to your safer investments.
Yeah, that's great. And I like how you broke that down for us and talking about what diversification truly means in those 9 sectors and a small cap or small capture companies that capture a smaller portion. That's all that means. People have probably heard the term small cap, large cap. I'm glad you pointed that out. And it really pays to work with somebody, a trusted financial professional like yourself, who knows what's going on and have been doing this for a long time. You've been helping people for years with this, and you have an extended back office. You work closely with the senior portfolio managers like Keith Gangle, who we've had on the show, or Mike Binger. And you can pick up the phone, get a hold of them and say they're actively watching things and managing, and you can even put them on the phone with your clients. So you have a direct tap right there. And I think that's fantastic. And the majority of people out there do not have that luxury. They can't call up their person and say, can you get me on the phone with a senior portfolio manager at some big, huge investment firm? And they're going to go, yeah, no.
So I'm glad you mentioned that, Tony, because what you just pointed out right there, and I have these discussions quite often at my classes that I present, as well as here in my office and one-on-one visits or on phone calls, is what Tony just pointed out is we have a company called Gradient Investments who sits on the Charles Schwab platform of managing money. What that means is they simply do all the research, they do all the building of portfolios, and they do all the buys and sells or trades within the portfolio. So they're the ones really running the money, running the show behind the scenes, right? So I ask a lot of times when people come in and sit down with me and they might have some random mutual funds inside of their 401k or inside their IRA or their Roth. And I ask them, how often have you ever got to get an email directly from those portfolio managers, meaning the people that are managing those mutual funds, the managers, not the advisor that sold you the mutual fund, or not HR who's in charge of your 401k, your employer, but the people actually managing those mutual funds inside behind the scenes. How many times do you get an email from them telling them why they're doing what they're doing with your money? Or better yet, how many times do you get to potentially have a phone call live with them to talk about how and why they're doing things the way they are within that mutual fund with your money? Or how many times do you get to see them face to face, speak live and shake their hand and ask them about the markets and the economy and your money? And 100% of the time, Tony, in 22 years, I've asked that question. Not one investor has ever had an opportunity to meet the mutual fund portfolio managers and ask them those questions. Not one of them gets direct emails from those people. And that's very powerful because with Gradient Investments, who manages the money for my families that I invest, that invest their money with me, they get weekly emails from the team, from Keith Gangle, from Jeremy, from Tyler, from Mike Binger. They get weekly emails from them that talk to them about what's going on in the markets and the economies and what are they doing inside their portfolios because of what's going on in the market and the economy.
Yeah.
We also have direct access to them. As you mentioned, Tony, we have direct access to phone calls. We set up quite a few phone calls, one-on-one phone calls, conference calls with those portfolio managers and my clients. So they can talk to them about, hey, I got these ideas or these objectives, or why is this money doing this? What are you doing inside the portfolio? So they'll talk directly one-on-one with our clients. And I have portfolio managers from Gradient Investments come over here at least once a year to do live events for my families. So that is a lot of power, Tony, a lot of control that you get to have with your money when you can shake hands with, look in the eye, and talk on the phone directly to the people in the trenches that are managing your money. So I'm glad you brought that up, because mutual funds are a great investment. There's absolutely nothing wrong with them. There's just a lot of disconnect. There's not a lot of personal service and advice and management. When you have mutual funds, they're more just very general to the world versus direct management.
Yeah, direct management and really tailored for you and actively managed for your needs and goals. I think that's great. So now we should probably give away some copies of your book. Let's take a moment to do that. We're going to give away 10 copies to the next 10 people that contact your office at GreatLakesInvestmentAdvisors.com or 989-835-7203. And the book is Empower Your Retirement. Plan for the best, but prepare for the worst, right?
Yeah. So it's a book that my dad and I spent, well, it took us a little longer to write this book than we anticipated, but life goes on.
It always does, doesn't
kids it? And then when you'd read 4 or 5 chapters and you just scratch it and start over, because when we put this book together, Tony, we really wanted to share 18 to 20 years at that point in time of real life experiences, how we've met a lot of different investors over the years and how we've helped them financially, as well as personally and professionally. And so I love the opportunity to share this book with our listeners and our viewers. So Tony, go ahead and give away 10 copies to our next 10 callers on the show. That'd be great.
That would be great. Thanks for allowing us to do that. You're very generous. So listeners, this is an actual book. There's no charge. You won't even have to pay postage. Pick up the phone, call 989-835-7203. That's 989-835-7203. And if you want to set up a consultation with Jason and his staff there, you can get the book when you come in for your consultation. If you'd like, you can do that at the same time. You can always reach out through GreatLakesInvestmentAdvisors.com, but calling is the best way, 989-835-7203. And the next people to reach out and say they heard about it on the radio and want a complimentary, no charge, no obligation copy of the book, and that's Empower Your Retirement, can do that. And we'll be right back after this. Welcome back to your Financial Empower Hour. I'm your co-host, Tony Shore. I'm here with Jason Cryderman. Jason, great show today. We're talking about investment basics today. And you've went over a lot of areas, talking about diversity within your portfolios, talking about actively managed accounts. What's something else you think our listeners should know about?
Yeah. So far, you're right. We talked about risk tolerance, right? Your investments should be based on your risk tolerance personally. We talked about allocation based on your risk tolerance, based on your goals and objectives with your money. How much money should you have invested to what I call riskier investments, more opportunity, but also more risk on the downside? And then how much of your money should you have allocated to safer investments, maybe not as much upside opportunity, but safer, even to the point of 100% principal protected. That's allocation. Then we touched on diversification. Diversification is how much of your money within the riskier should you have invested in certain companies, certain sectors, international, large cap, small cap. That's diversification. And how much as well on the safer money side, how much should you have investor diversified into short-term, medium-term, long-term, maybe CDs or bonds or other fixed income accounts. Another important thing to take into consideration, Tony, and really maybe we should have started with this topic, but when you invest money, our money that we invest gets hit with one of three different tax treatments. Meaning when we invest money, it's either going to be taxed every year, it's going to be tax deferred, or it's going to be tax free. So that's important to point out because we can put away X amount of dollars. We can invest it aggressively. We can invest conservatively. We can have it in mutual funds. We can have it in stocks. We can have it in bonds, variable annuities, fixed index annuities, any different type of investment vehicle or tool that you can use. It's going to be in one of those three types of tax treatments, either a taxable account, a tax deferred account, or a tax free account. And you can own any of those investments, Tony, inside of any of those three accounts. So let's touch on that real quick. Most people are really familiar with what I'll just call a taxable account. And that's like savings, checking, CDs, brokerage accounts, stock accounts. Really, it's almost any form of investment that's not inside an IRA, a 401k, or a Roth. So if we just have CDs at the bank or high yield accounts, or let's say we have maybe some stock in the stock portfolio or some mutual funds inside just a non-IRA portfolio. Well, anytime we have gains on those monies, we get a 1099. It's a taxable basis every year. So those are what I call taxable accounts, or where the gains are taxed annually. And those are very common. One of the cool things about those accounts, for the most part, unless the investment inside restricts you, for the most part, when you have a taxable a taxable account like that, you can put money in and take money out at almost any time with no limitations, no restrictions from the IRS. Why I say that is because if you have money inside a savings or checking or high yield account or a stock or brokerage account, you can add money and take money out of there pretty much at any point in time you'd like with no IRS regulations. However, when we transition to tax deferred accounts, now we're talking about corporate 401ks, like a company sponsored 401k or 457 or 403b, or your own personal IRA. Those types of accounts, we do have to start paying attention to IRS regulations, meaning how much can we put into those accounts per year? Some or all those accounts are limited based on a certain dollar amount, that there's a maximum amount. You can't go over that. Some of those accounts you're restricted and can't contribute to per year if you make too much or don't make enough money. And then the money grows tax deferred, which means you don't pay taxes on the growth as the account is growing, but you will pay taxes when you take the money out later in life, as well as some of those accounts when they're tax deferred. If you take the money out before certain ages, not only will you pay taxes on that money, you could also pay early withdrawal penalties. So those aren't as what we'll call liquid. Those aren't as flexible to put money in and take money out as you wish. If that's your objective or your goal, you want to put some money in those non-IRA accounts, non-Roth accounts, just like the brokerage accounts, savings, checking, high yield, those types of things. And then we transition to tax-free. Tax-free, a lot of times when I put on my classes, I put on my educational classes that I do, Tony, and when I talk about tax-free, all the ears, all the eyes open, all the ears perk up, everybody leans forward in their chairs. Everybody wants to hear about tax-free.
Sure. We all want to minimize our tax burden.
All want to minimize our taxes. And I will be 100% open and honest with you, with all my listeners, all my viewers. Tax-free sounds awesome. It's not always the best for all your money. Right. Again, your plan should be built on your goals and objectives, your allocation, your diversification, your risk tolerance. All these things come into play, as well as how much of your money should be in taxed every year accounts, tax deferred accounts, and tax-free accounts. So when we talk about tax-free accounts, the most common that people are familiar with is Roth. Roth IRAs, under today's law, all the money that you put into Roths has already been taxed. That's important to point out, Tony. If you make a contribution from your checkbook, you've already paid taxes on that money.
Yep.
If you do a conversion from an IRA to a Roth, you have to pay taxes on that money the year you do the conversion.
Or a 401k to a Roth.
Or a 401k. That's absolutely correct. So all the money that goes into a Roth, and a Roth is just one tax-free vehicle, all the money that goes into a Roth has already been taxed. Now, under today's law, really cool aspects of Roth IRAs is that 100% of the growth inside, whether you own a CD, a stock, a bond, a mutual fund, a fixed annuity, an index annuity, a variable, and no matter what type of investment vehicle you own, 100% of the growth is tax-free, meaning you will never pay a dime of state or federal income tax under today's law
if it's inside a Roth.
Of any of the growth inside a Roth IRA. That's absolutely correct.
And so all that growth from now until when you need it, it's going to grow tax-free. So when you take it out, no taxes on the principal, on the growth. And so why wouldn't you want to, at least some of your money get out of those tax-deferred accounts, pay the taxes now when taxes are low, and put it into a Roth, and it grows tax-free? That's probably a good idea for some people.
For some people and some of your money, absolutely is. So as I mentioned, it grows tax-free. And Tony, you hit the nail right on the head. And when you said when you take money out of the Roth, it's also tax-free. That's also a big, big benefit of a Roth IRA under today's law. Not only does it grow tax-free every year, but when you take it out as income, yourself, your spouse, your kids after you pass away, whoever it might be, when that money comes out of the Roth IRA under today's law, it is 100% tax-free.
It won't count and it won't count toward your income to bump you into a higher tax bracket.
Correct.
Well, this has been a great discussion. Unfortunately, we're running out of time. I have to cut it short.
All good things must come to an end, Tony.
Exactly. So before we go, Jason, let's give away a few more copies of the book, okay? We're going to give away another 10 copies of your book, which is called Empower Your Retirement. So again, the next 10 people to contact your office at Great Lakes Investments Advisors, all they have to do is call 989-835-7203. That number again is 989-835-7203 to get a copy of Jason's book or set up that no charge, no obligation consultation and get a plan in place. Well, Jason, great show.
Great show today. Thank you, listeners. Thank you, viewers. Tony, we'll see you all next week.
All right. See you next week. And that does it for today's episode of Your Financial